Now that we had run ourselves through topics under corporate reporting, let us look at content of director's report. Content of director's reports. And I think it's good that we remind ourselves of who directors are and classes of directors that we may have, whether it's a unitary board of director, whether it is bilateral board of director structure that we are operating on, irrespective whether a director or some directors are in the class of executive directors, non-executive directors, any form of directorship that we may belong in. One thing that is common to us all as directors of organization must be that we must report. Corporate governance key and emphasizes reporting. And as accountants, as people at the helm of governance of organization, we cannot but know how to report, and that is why we have this as a course, corporate reporting. So having established that, we can have unitary, we can have bilateral form of director, we can have non-executive directors, we can have executive directors, we can have independent directors. Both all forms and shades of directorship must report, and let us look at the reports of directors. What are the things that directors must ensure to report on? It doesn't really matter which country we are operating from. One thing is common in corporate governance. Corporate governance is universal, and even though we are working on corporate reporting now, we should not forget that when we are discussing the topic of directors reports, we are under the topic of corporate governance also. So these items on the list are important to every nation, to every country that we must organization must report on. So primarily, first of all, reporting must be fair. Reporting must be fair. We must establish that content of financial statement must be fair, fairly presented. And that is why we'll be talking about the auditors, external auditors, internal auditors, and the like, to ensure that okay, things are put in perspective before reporting to the stakeholders, which may involve the shareholders and other public interests. So, having established that fair presentation, then let us look at other things. A fair view of the development of the business of the company and its subsidiary. That should in case the organization is a group during the year under review, and the position that we are as at the time of we are reporting. So we must brief the house, if I may use the word, that is the general stakeholder, on the development of the business, how we are faring, how far we had gone, what we set out to do, and as at now that we are reporting, how far had we gone? Are there constraints and the like? Directors must be able to pinpoint this out to the stakeholders. The amount, if any, in which the directors recommend should be paid as dividend. Directors must mention and talk about dividend. And as a matter of fact, the power to decide on the amount of dividend to be paid actually lies on the shoulder of the directors. The directors have the capacity and the ability and the authority to decide the dividend to be proposed and to be paid. The only thing the shareholder among the stakeholders can do is to approve of it or disapprove of it, but the directors must be expressed and stated clearly the dividend that they are proposing to be paid to the shareholders. Having said that, the name of the person or persons who were directors of the company at any time during the year must be expressly stated. That is, directors that participated during the course of the business operation during the year. Don't forget that as part of Code of Corporate Governance and Ethics, directors duration should be tenured. That is, they have limited time to spend in an organization. So especially for the non-executive directors, the independent directors, maybe 3 years, and if reappointed, another 3 years, depending on the Code of Corporate Governance ruling within a country. But generally, globally, directorship is a tenured office. So because it's a tenured office, it is important to specify and let the stakeholders know who and who are the directors that worked as at the time the report is going live. Another thing that must be expressed by the directors are the financial activities of the company, and if any, the subsidiaries in the course of the year, and any significant changes in this activity during the year. Any significant changes, maybe there is a there was a subsidiary that are now being sold off, they need to mention it. Maybe there's a takeover in one of the subsidiary, or any financial activity that is of importance in nature and significant must be stated. And when we are talking about significant, it may be a bit of subjective word. So the dimension of significance depend on the organization's judgment and the volume of activity and how they see themselves generally. Another point that the directors must be conscious of to express about in writing in the corporate report is the particulars of the significant changes and fixed assets of the company. Do we have important assets sold in the course of the year? We must mention them. The difference between the market value and the amount at which it is recognized in the financial statement must be stated, especially if there is a landed property that is being sold or has been sold. Is important to state it among many other classes of assets, and especially when the directors are of the opinion that it is important for the knowledge of the debentures and general stakeholders so that they can be aware of it, and the reason should be expressly stated too. The details of directors' interest in the company's share and debenture. In fact, as a matter of code of corporate governance, any national stock exchange frown seriously on non-disclosure of directors' interests in organizations' share and debenture or any form of floating in the organization. So it is expected as per ethics that every director should mention their interests, and as a corporate unit of body of directors, they must report on their interest in the share and debentures of the organization, and here even on contracts in which the organization has engaged itself in. The particulars of any important event affecting the company which have occurred since the end of the year must be mentioned too. Just like I said, if we go into a contract, maybe the contract was gotten by the or through the help of one of our directors, we must let the house know and report it that so and so has interest in such and such contract and the like, just for the sake of full disclosure. An indication of likely future developments in the business, especially as touching on going concern effects on the organization. It is important that we bring to the house and table it all down before the house anything about the known or envisaged developments that may affect the organization in the nearest future time. May not be directly initiated by us, maybe scanning through the macroeconomy. We find that little time something will happen. We need to let stakeholders be aware of it and, if possible, propose a way forward. Any indication of the activities of the organization in the field of research and development. Do we have any amount allotted or being spent or has been spent on R&D? It is important that we let the stakeholders know. One of the reasons is this: R&D is more or less a lifeline, especially in some industries, and it could go up a lot of money. So, and at the end of the day, let's take for example research and development in the area of petroleum exploration and like. At the end of the day, we may have a dry well. Meanwhile, a lot has been spent into it. So, if we do not carry the whole house along concerning it, that may not be fair enough corporate reporting. Don't forget, when we started, I said it that generally we must establish one fact, that corporate reporting is standing on fair reporting or fair reportage. So for fair reporting to happen, we must be able to disclose research and development on that is currently being undergoing or which we've spent money on. Another thing that we must disclose or talk about is the name of the distributors of our products. Names of distributors of the company's products, we must mention it, and these still relate directly with directors' interests too, should in case. This knowledge is important for stakeholders, probably to be well guided, to probably to have at the back of their mind that there is relationship between different companies and can be on the lookout, that is general stakeholders now, be on the lookout for intercompany transaction and the like. Also, donations and gifts made in the course of the year should be reported. And don't forget, there are major classes, two classes of donation. You can have some that are maybe statutory. I don't want to use the word mandatory, but statutorily recognized donation. Of course, majority of the time, nations will grant them to be allowable expense so that organization can encourage and impact directly, positively, the world around them. Also, should in case in the course of the year, as board of director, we had spent on what we believe are justified and necessary, but on the regulatory side of things may not be statutorily allowed in form of taxation. They should be disclosed too. And of course, they may be disallowed, but that does not say that we should not impact positively in the area that we know is good and best for our organization and community in which we fund our organization to be. It is important too to mention under donation and gifts that these are the things that lead to positive or negative organizational footprints. Positive or negative organizational footprints. So if the directors are like of the opinion that the company really should not participate in giving donation, maybe because it is not statutorily allowed and the like, and they did not participate, and the world around them, that is the organization where the organization fund itself, is not that